Cheers to a fresh episode of Business Insight. I am Olaoluwa Awe. Today we're diving into an engaging discussion on the basics of the capital market. And of course, we'll continue our conversation on the rights of shareholders and corporate actions. However, before we delve into the main discussion, let's start by providing you with some business news and highlights of market trends. The Nigerian Sovereign Investment Authority, NSIA, has invested over $500 million in domestic infrastructure with plans for another $1 billion in third-party investments, according to the authority's managing director, Mr. Aminu Sadiq, who revealed this during a hearing by House of Representatives ad hoc committee in Abuja set up to ensure NSIA's adherence to the legal provisions of its establishment. Financially, NSIA reported a profit after tax of 96.9 billion naira at the close of 2022, a decrease from 146.9 billion naira the previous year. A decline was attributed to a drop in financial assets categorized as fair value through profit and loss. President of the Association of Local Government of Nigeria, Algon, Kolade David, acknowledged NSIA's noteworthy contributions in health and education. But NSIA's investment efforts hold promise for Nigeria's economic development. Despite the careful monitoring of its investment decisions, risk management practices and financial performance is important, and addressing the decline in profit and clarifying the reasons behind it will be important to restoring investors and public confidence. Nigeria's recent auction for one-year treasury bills offered investors 1.5 trillion naira at a striking rate of 13.9% per annum, but only 283 billion naira was accepted due to oversubscription. Despite offering a negative real return in the face of rising inflation, 24.08% in July 2023, there continues to be strong demand for this risk-free investment. The auction results revealed similar trends for 182-day and 91-day treasury bills, where investors oversubscribed against the central bank's offer. The country's stable money supply of over 64 trillion naira and a combination of lower interest rates are believed to contribute to observed exchange rate depreciations. And the Nigerian Exchange Group is considering the introduction of dollar-denominated bond listings on its platform to address the foreign currency challenges faced by companies in Nigeria. CEO of the NGX, Temi Pupola, said the move will empower companies to issue bonds and potentially even equities in dollars, thereby mitigating the adverse impact of currency fluctuations. Apart from proposing dollar-denominated listings and foreign currency bond issuances, the NGX is collaborating with the local Securities and Exchange Commission, SEC, to revise regulations which would enable selected companies to distribute dividends in dollars. Although specific timelines were not provided, Mr. Pupola noted that the government has demonstrated a strong interest in broader market reforms, suggesting that changes to listing regulations could be implemented quickly. And moving on, the North Central Millers Association of Nigeria is predicting a surge in the cost of 50 kg bag of rice in Nigeria from an average of 43,000 naira in mid-August to a range of 55,000 naira to 60,000 naira in September 2023. This is due to dwindling supply and production difficulties faced by smaller rice mills who are producing less and closing down their mills. The National Vice President, Jonathan Joshua, says the shortage of paddy, raw material for rice production, due to the closure of the Nigerian and Nigerian border, has further hindered the import of paddy from neighboring countries, which is aggravated by India's partial ban on rice exports, supplier and world's leading rice exporter. Even imported parboiled rice used to bridge supply gaps has experienced price hikes as India's export ban reduce the global rice supply, propelling international rice prices to a 12-year high. And Dubai International Airport announced that it served 41.6 million passengers in the first half of 2023, surpassing the passenger count for the same period in pre-COVID 2019 and marking the 9th consecutive year of being the world's busiest international airport, according to CEO of Dubai Airport, Paul Griffith. Attraction sites such as Burj Khalifa and Burj Al Arab luxury hotels have lured visitors and transit passengers out of airport lounges. The Emirates airline at the airport also witnessed robust profitability in 2022, generating $2.9 billion. While Dubai International Airport celebrates its remarkable recovery, challenges associated with limited expansion space are resurfacing, but a plan is in place to invest up to $2.7 billion to upgrade terminals and parking facilities, extending the airport's operational capacity for around 12 to 13 years. And a recent report from the World Travel and Tourism Council has revealed that investment in the travel and tourism sector are on a path to recovery with a projected value of $955 billion by the end of year 2023. This prediction indicates an 11.5% growth in investment with a goal of returning to pre-pandemic levels by 2025. The report anticipates a global average annual growth rate of 6.1% in travel and tourism sector by 2033, with Asia Pacific and the Caribbean leading the way in annualized growth rates. Notably, the United States has led in absolute travel and tourism investment in 2022 with a total of $213 billion, followed by China with $146 billion and Saudi Arabia with $42 billion, while certain island destinations like the U.S. Virgin Islands directed a substantial share of their economies into travel and tourism investment, focusing on areas such as hotels, aircraft and car fleets. The report also foresees the industry facing some challenges due to rising global interest rates. It is now time to bring you updates from the capital commodities and currency markets. Stay tuned for that. Today's trading session on the Nigerian Stock Exchange (NGX) saw a total of over 348 billion shares exchanged in 6,237 deals, amounting to a market value of 4 billion naira when compared to the previous trading day on Tuesday. There was a 19% increase in trading volume, a 2% decrease in turnover, and a 6% rise in the number of deals. The overall market capitalization of the Nigerian Stock Exchange is currently at 35.9 trillion, and a total of 116 companies listed on the NGX took part in trading, resulting in 22 gainers and 27 losers. Associated Bus Company led the gainers with a notable 9.62% increase in its share price, closing at 0.57 naira per share. Thomas Wyatt Nigeria saw a 9.3% gain in share price. Transcorp Hotels 8.99% gain, while Kurtville Business Solutions saw an 8.33% gain value. On the losing side, Corn Oil had the biggest drop with a 10% decrease in its share price, closing at 99.00 naira per share. This was followed by Dark Communications, a minus 9.38%, Red Star Express, a minus 8.75%, and Tantalizers, a minus 8.33%. Among the companies with the highest trading volume, Transcorp Nigeria took the lead with 145 million shares traded, followed by Universal Insurance Company, 27.5 million shares, Dangote Sugar Refinery, 16.1 million shares, and Fidelity Bank, 15.8 million shares. And away from Nigeria, yesterday's trading session on the Ghana Stock Exchange GSE concluded with a total of 169,611 shares traded, valued at over 874,800 cedis. When compared to the previous GSE trading day, there was a significant 91% increase in trading volume, although there was a 24% decrease in turnover. The total market capitalization of the Ghana Stock Exchange is currently 73 billion cedis. A total of 19 equities listed on the GSE participated in the trading, resulting in only one gainer, which was Standard Chartered Bank, with a 1.55% increase in share price. The highest trading volume was recorded by MTN Ghana with 74,864 shares traded, followed by Standard Chartered Bank 40,521 shares, Total Energies Market Ghana 18,353 shares, and Societe Generale Ghana 15,913 shares. Now let's get to the commodity markets. In this market, several trends have emerged. Notably, wheat has attracted attention with a current value of 613.75 US cents. Gold is noticeably highlighted, valued at 1,918 US dollars. Silver closely follows at $24.27, while copper slightly trails behind at $3.81. Now shifting to the energy sector, Brent crude oil has firmly established itself in the market with a rate of $83.23 per barrel. And now let's quickly explore the most recent currency exchange rate. According to the Central Bank of Nigeria, the US dollar is presently officially valued at 754.21 naira for purchase and 755.21 naira for sale. Meanwhile, the British pound is quoted at 956.79 naira for purchase and 958.06 naira for sale. Regarding the euro, the official exchange rate is set at 817.94 naira for buying and 819.02 naira for selling. And that's the market trend for now. I am Olaoluwa Awe. After the break, we'll continue our conversation on the rights of shareholders and corporate actions in the capital market. Don't go away. Interesting day, I must say. It is on Business Inside today. Welcome once again. I am Olaoluwa Awe, and today we'll continue yesterday's conversation on shareholders' rights and corporate actions. We were able to touch on some shareholders' rights, but we could barely even say anything on that's corporate actions. That's what we're going to do today. We're also really going to try to touch on treasury bills. It is very important we do these things so that you all know what the investment options you have in the capital market. Joining me today at the table is Ahmed Jayola, our in-house analyst. Welcome to Business Insight.
Thank you very much.
Hope you enjoyed your time yesterday.
I tried.
Yes, I also understand that the man with over 30 years experience in the capital market will join us on the show today. I'm talking about Professor David Adori. We'll wait for him to join us, but before that, we'll engage Ahmed Jayola, and let's just do a recap of some of the things that we were able to touch on yesterday as regarding shareholders' right to vote. I know we majored in that yesterday.
Yeah, I think we talked about proxies, having representation, someone going to represent you at the voting table. Okay, so voting rights have a direct influence on even the shareholder themselves, because when they know that they have the rights to vote, they are much more involved, they are much more committed, they are much more attentive at meetings and so on and so forth. So they want to hear everything that is going on, they want to know everything that is going on, and it has this what do you call it, influence, so to say, also on the company itself, because when the company when the shareholder knows that they have a right to vote, then the company sits on their toes, because they know that, okay, if we say anything that is questionable, this guy is right. So but that is because both the shareholder and the company know that the two of them know what is going on.
Yeah.
But in the case where the person is uninformed or ill-informed, you now start having a case of maybe, okay, so we mentioned proxies yesterday, right? You pick a proxy, for example, to go and represent you, and someone has already come to the proxy and has given him maybe some change and say, okay, so when it comes to voting, or vote on, vote this or vote that, right? The proxy not been informed, or should I say, not knowing exactly, not properly informed. I think that's the best way to just put it. All right, can just decide to throw the vote away and just vote however the person suggested.
Yes.
Right.
Yes, I understand that we also touched on e-voting yesterday.
Yes.
If you missed it, you can go to our YouTube page at Souq News to check out that previous edition. But let me, at this point, bring in Professor David Adori with his 30 years experience in the capital market anyways. Good morning, Professor.
Thank you very much. Good morning, especially to the in-house analyst and to you and to all the viewers.
Thank you very much for joining us.
Thank you very much.
So we'll continue our conversation from where we finished yesterday. Let's now talk about the shareholders' rights to preemptive information. For example, we understand that shareholders might have the opportunity to buy additional shares before it's even offered. So let's talk about the right to buy shares. Could you just give us the rights shareholders have in this light?
Okay, thank you. That is a basic right of shareholders. Is even more pronounced when we're talking about shareholders in private companies, because private companies are not allowed to offer their shares to the investing public until they have converted to PLCs. And so if there is a need to increase the capital base of any private company, for instance, the shares issued by the private company, the new shares, are first offered to the existing shareholders in line with their shareholding. However, In the stock market, where we have publicly quoted companies, of course, we call it rights issue, is still the same procedure wherein if the general meeting of members approve for increase in the capitalization of the enterprise, the new shares that will be issued will be issued if agreed or resolved at the AGM to the existing investors by way of rights. So we call it rights issue. And so the meeting will decide as to the proportion to which the shares will be allotted or offered to the existing shareholders, and also how much will be paid per share in the rights issue. So the rights issue, therefore, is exclusively for offering to existing shareholders and not generally to the investing public.
Thank you very much, Professor Adori. Before I get to Ahmed, let's also talk about shareholders' right to sue. You know, I understand that the shareholders can take legal actions against the company if they believe that the company's management is not acting in their best interest. Could you please explain this to us with examples, perhaps?
Yeah, thank you. Now, companies, especially those that are listed on the stock exchange, they normally have a majority shareholders and minority shareholders. And there are instances in which the majority shareholders may be oppressive against the interest of the minority shareholders, because generally, like I said earlier on, it is the prerogative of the majority shareholders to appoint directors, because when they vote at the general meetings, the will of the majority shareholders prevail. And so they are able to constitute the board of directors, which has the responsibility to drive the policies of the organization. And in driving the policies of the organization, they utilize management that they have appointed to do that. So in some instances, the majority shareholders acting through the directors may not be organizing the business or managing the company in the best interest of the company generally, or in the best interest of all the stakeholders. And so there might be instances of oppression of minority shareholders. And so this can therefore lead to what we call a class action by the minority shareholders to protect their rights. And these are appropriately provided for under the Investment and Securities Act, where we have elaborate provisions under the law to protect the rights of minority shareholders. And so any minority shareholder, or indeed class or classes of minority shareholders that feel oppressed, or they are disenfranchised in the management of the business, or that the business is no longer being organized in the best interest of all the stakeholders, have a right for a course of action by applying to the High Court. Well, in the past, but now we have a special tribunal in the capital market called the Investment and Securities Tribunal, IST, wherein they can seek redress by filing actions against the company or the majority shareholders.
Thank you.
Now, to actually be protected.
Back to you, Ahmed Jayola. As an individual, can you single-handedly sue a company for issues, maybe with dividend or something? If you feel like the company,
How
whose
much is the
shares you
dividend
have,
that I'm going to sue a whole company? Well, actually, yes, you do have the right to sue a company. However, eh, however, in the horizon, I see that happening. But you're a shareholder. Majority shares, minority shares, a share is a share, right? You might have the right to, should I say, let me not call it right, but you might have a set of preferences when it comes to maybe voting rights and the rest of it. But if the company is doing something untoward and you are not okay with it, and it requires what do you call it? Something, a law or getting involved, getting the court involved. Of course, why not? You can take the company to court, and if you have your case, you win. So it's not so much of a elephant fighting the rat situation, or what do you call it? Something that's impossible to do. You can actually, based on your rights as a part owner of the company, take the company to court and say, okay, so this is wrong, this is wrong, this is what I want, this is what I want.
but I believe that before it gets to that, there are usually options for shareholders to explore, to settle
Well, it is
disputes
true.
and.
So mostly, a shareholder won't just get up and just go to court. Do you understand? When all options have been exhausted and there is no redress, then you now start talking about taking it outside, for the courts to settle. But in most cases, it is usually, discussed. They will have written letters, a lot of correspondence will have gone in place. A lot of mediation would have, taken place. Nobody wants to go to court and go and sit down and be answering yes, my lord, yes, my lord. Now, nobody wants to do that. But if every opportunity has been exhausted and that's the only option that is left, then that is it.
Now back to you, Professor David Adore. Let's talk about shareholders' right to liquidation preferences. In the case when a company wants to liquidate or file for bankruptcy, what are the options that the shareholders have at this point in time?
Thank you. The shareholder is the residual risk bearer in an enterprise. And so that is why the shareholder has enormous rights to manage the business and ensure the going concern capacity of the business, and that the business is managed profitably for the interest of the stakeholders. But events can turn the other way despite the best efforts of the shareholders to profitably manage the business. And so it may eventually cause bankruptcy proceedings to be undertaken by liquidators against the company. So in this case, like I said, the shareholder being the residual risk bearer means, therefore, that when there is liquidation of the enterprise, the creditors, or what we call the senior debt holders, are settled. First, of course, liabilities to the government are settled by way of taxation that have not been paid. And then if there are existing liabilities to staff, they are also settled. And then creditors are settled in line with the secured nature of their credits. Secured debts are settled first before unsecured debts. But if we still therefore have any asset left after all the creditors have been settled, of course, such assets will be distributed in line with the shareholdings of the investors to the shareholders. But unfortunately, it depends. If at the end of the day, all the assets have been shared to the creditors, there may be nothing left for the shareholders. So that therefore underscores the risky nature of investing in the equities of enterprises and the need for investors to be very, very cautious while investing in enterprises. Thank you.
Thank you very much, Prof. Adori. That brings me to the next line of conversation here, which is corporate actions. Corporate actions, from our understanding, are events or activities embarked on by publicly traded organizations or companies that affect the shareholders or affects the structure of the organization. And when I mean structure, we're talking about things like the ownership structure, we're talking about financial health, the stock price and all of those things. So from time to time, these publicly traded companies, engage in one or two things. And one of it is as simple as dividends. Yes, they pay dividends from time to time. But we'll also need Professor Adori to talk on stock splits. Why do companies do stock splits? And what's the benefit in that for investors?
Okay, thank you. You're talking about splitting the stocks of an enterprise. Of course, though that is not very popular here, what we have here more is a consolidation whereby excessive outstanding shares are condensed and reduced to manageable level. The instances where an enterprise can split is outstanding stocks to increase the number of outstanding shares would be if, for instance, the shares become excessively high in unit price, and in which case it might fall out of the objectives of the enterprise, perhaps, to make the shares available to a lot of retail investors, to make the shares affordable to many retail investors, so as to have a large shareholding base. So in that case, an enterprise or a company can agree via, of course, the unanimous resolution of the general meeting of the company to split the existing shares in a ratio that they will decide so as to increase the number of existing shares. But splitting the shares, therefore, will proportionately assign to each new share a fraction of the old shares. But there's another thing, I hope that is not what perhaps we are referring to, which we call scrip or bonus issues, which occurs if an enterprise at the end of a trading period does not want to distribute cash dividends. And so the enterprise can also give what we call a scrip issue or a bonus issue, wherein they capitalize a part of their capital and convert the capital into new shares, which they now share to the existing shareholders in the ratio of the existing shares that each shareholder already owns. So that is called a scrip. So
Thank you.
That was differentiated from a split.
Stock.
Thank you.
Yeah, thank you. Ahmed, do you want to add to that?
He has said the major, thing about
stock splits.
Stock splits. However, I think one of the other things that he needed to have added is it doesn't increase the value of the stock. They split the share quite all right, but so take for example, maybe I have one stock, right? And then there's a stock split. Okay, it doesn't increase my stock value. It only splits my stock into two. You understand? So there is more stock, there's more shares rather, but it's still at the same value. Do you get the point now? So, but aside that, everything else is...
But is there any benefit in that for investors?
Okay, so most of the time it's when, like I said, when the value of a share is quite high and it's becoming too expensive to buy, right? They do that so that it will be cheaper for people who want to come in to buy, shares, because you can buy it at the existing high prices. So for those that already own those shares, okay, the value is still the same, but for those who are coming in, they are buying it at half the value if it is split into two.
All right, thank you. Now, let's get back to Professor Adori and talk about stock buybacks. I think we've seen a couple of that in recent times in the Nigerian capital market, where companies buy back their own stock. So why does this happen, and what's the opportunity in this for investors?
Yeah, when you have the company issuing very excessive number of shares in the market, the returns per share becomes very, very little to be attractive to investors. And as a result of which, the liquidity in such shares might be highly limited. And so it's one of the reasons why you can have buybacks so as to limit the number of shares. In secondary, when, for instance, the majority shareholders want to
And welcome back to Business Insights. Sorry for the break in transmission. We were just talking about shares buyback. And this is one of the corporate actions public listed companies take in the capital market. And this decision sometimes affects the price of their shares, affects the ownership of their shares. It also affects the company structure generally. And I was just having that discussion or that conversation with Professor David Adori. But Ahmed Jayola is with me here in the studio, and we'll be having a stake on that. So talk about share buyback. As I mentioned earlier, I think we saw a couple of that happened in the capital market here in Nigeria recently, where some companies bought back their shares. I think, I don't want to mention names, but why do organizations really do these things?
So many organizations, let me not say they don't do it intentionally, okay? But in some cases, it's, how would I put it now? To control exposure in some cases. For example, maybe they've already declared ordinary shares out there. They've already declared different kinds of shares out there. And they've raised the money that they want to raise, okay? But then they need to restrict who has access to the stock, right? So they initiate a share buyback so that they can have control of those shares. Sometimes it's also for control. Say, for example, they need to maybe take faster or much more efficient decisions, and they feel like, okay, so if we leave it to the stock market, or I said to the shareholders, okay, and maybe if there's a percentage that is not favorable for the company to take certain decisions, they will initiate a share buyback so that they can buy some shares back, and then they will be able to have controlling decisions and be able to make faster decisions and so on and so forth. So there are different reasons for share buybacks. Some do it for frivolous reasons, right? Some do it for very, very crazy, You would even ask questions, and the answers you would hear would even make you ask more questions, right? So there are different reasons for share buybacks. One of the reasons why you're seeing it happen that it's almost beginning to look like a trend in the country is because a lot of people seem to have seen an example, and they're like, oh, we can do that, and then they follow. All right? Because it benefits the company. Share buybacks usually benefits the company, not so much of the shareholders. Let me clarify why I said not so much of the shareholders. It benefits some shareholders, not many others. Okay, so it depends on the categories that they have allowed, access to or non-access to. So the company does it a lot for different reasons, but it's now dependent on who wants to get into trouble, who doesn't want to get into trouble, who is doing it for what they call it, decision-based reasons or structural-based reasons or financial reasons in some cases. But, share buybacks can happen at any point in time, initiated by the company and the major shareholders of the company.
Now, it's time to talk about mergers and acquisitions. These are also bold moves that companies make, and in a way, it can affect the price of their shares, the ownership of their shares, and so on and so forth. So let's talk about when one company acquires another. In what ways can it impact on the company ownership and shares?
Mergers and acquisitions are not so much of a general use case, if I may put it that way. Because in the first place, before you merge with another company, there must be a strategy at the end of the day. And a lot of times, this is usually publicly discussed. When I say publicly, I'm not talking about public outside. I'm talking about within the shareholders. Okay, so every shareholder has a right to know that, okay, so we intend to merge with this other company for so reasons. All right? If we want to acquire another company, we must also be clear as to the reason we want to acquire that company. So most of those decisions are not taken behind any shareholder, except you do not attend the meeting. All right? In a lot of cases, you would also see some of these things happening in maybe sometimes public conferences, right? Where they will announce after the private meetings with the shareholders, they will announce to the public, okay, so we are doing this, and they will still explain the reason for doing the merger or doing the acquisition of the company. So most of the time it blends with company strategy. If the company says to themselves, okay, these guys are a competition, right? And of course, you have the commissions that are in charge of looking into that, where they try to protect monopolistic tendencies from many companies. So if the company looks at it, this is my competition, okay, so what do I do to be able to stay ahead of the competition? Do I merge with the competition, or do I buy the competition? These are the points where these kind of decisions get taken.
Now, let's quickly also talk about corporate actions like spin-offs. Unlike mergers and acquisitions, this is when a company might separate a part of its business into a new independent company, unlike mergers and acquisitions, where you merge with another company. This time, you create another company from what you already have. We also have right issues, we have bonus issues, we have DRIPs, which we call the dividend reinvestment plans. There are tender offers, and there are things like change in company name or ticker symbols. And how can these things affect the overall structure of the company and the value of the shares?
Okay, so it's dependent on what is going on. Sometimes in the economy, maybe things are going through a downturn and the company needs to strategically, bounce back. There are different strategies that companies use. In some cases, if there is an arm of the company that is doing so well, they would, create a new company from that. In some cases, when maybe there is the need for how would I explain it now? I don't want to call it sell-off, but kill off a particular part of a business, okay? they would not necessarily say that they are maybe trying to recreate another arm. This time they would call the shareholders together and they will know that, okay, so this particular arm of the business is going to die. We are going to continue with this particular other arms of the business. So the question now is, should we go on with the name that we are using now, or should we change the name? Everybody would be informed. So that's when change of names happen. You mentioned, which other ones did you mention earlier? I don't remember the ones.
We've
the other
talked
ones
about spin-offs.
Spin-off. A spin-off is basically, trying to come up with another name that is similar to the previous one, or trying to come up with a company that does the same operations
Or something, a part of
or
the
something
operation.
similar. So you have different
Rights
things that are
issues and
happening. Yes, you have different ones. But I think the major thing that everybody just needs to understand is, for many of these things, it's the company that decides which strategy. So the strategy is what decides what they're going to do. Right? It's not so much of the name exists and they just pick it and they just, no. Whatever it is that is happening is what determines the way the company is going to behave. And that is also going to determine what is going to be called. So if it is something that is maybe going through a downturn, then it's something that we have to, look at and take an action about.
I think the key lesson in all of the things that you've said now is the need for that tight communication between the company and the shareholders.
Yes.
Because irrespective of whatever action you take as a company, the moment you are at par, you are on the same page with your shareholders, it might reduce the impact, the negative impact of that move on the price of your shares and, the profit or, the size of your trading or whatever. But I think that's the big lesson here. Now, we have come to the end of the program. Thank you very much for your time, Ahmed
Thank you for having me.
And hopefully tomorrow, when we do the last lap of this series, we'll touch on treasury bills and, we'll take more questions, touch on all the other areas that we have not been able to touch on today. Thank you all for watching as well. I am Ola Oluwawe. Have a nice day.